Why does this happen? When Treasury auction demand is weak, big Wall Street firms often step in to buy. But once new investors arrive, these institutions may sell their holdings, building up cash to invest again at better prices. China and Japan, the largest holders of U.S. debt, also signaled Treasury sales, seen by many as an economic countermeasure. As a result, efforts to shift capital from stocks into bonds didn't fully succeed. In short, the temporary tariff suspension aimed to ease the government's cash crunch and support Treasury prices. But this likely isn't the end. Many view this as just the first move, testing the market's reaction. The strategy behind tariffs is similar to rate hikes: disrupt global markets, then buy assets at distressed prices. The difference now is that tariffs aren't a response to crisis, they might be the cause. When U.S. interest rates rise, global capital flows into the U.S. for better returns, weakening other countries' markets and currencies. U.S. investors can then use their stronger dollars to buy undervalued foreign assets, extracting value from the global economy. Now tariffs serve as a more direct way to achieve this effect. For example, imagine the U.S. puts a $4 tariff on Vietnamese goods previously sold for $10. You have two options. Option 1. Raise your price to $14 to cover the tariff. This likely reduces demand, resulting in fewer sales, business losses, layoffs, and eventually, broader economic slowdown. As dollar inflows shrink, your currency and assets lose value. Option 2. Keep the price at $10 and absorb the tariff. Your profits disappear, leading to potential business closures and job losses. The outcome is similar: a weaker economy, currency, and asset valuations. Some countries try to offset tariffs by devaluing their currency. For example, if hit with a 40% tariff, a country might devalue its currency by 40% to stay competitive. This makes its exports cheaper. It also means its assets are less expensive for foreign buyers, like when the yen drops. It's making Japanese goods and assets more attractive to outsiders. Regardless of the response, the outcome is similar. It becomes harder for the country to earn US dollars. This leads to a weaker economy, falling currency, and discounted assets, allowing dollar holders to buy distressed assets worldwide. That's why tariffs impact not just the US, but global markets as well.